Alibaba has two major problems. It is no longer Chinese most valuable e-commerce firm. They lost this battle to its rival Pinduoduo. Also, the management decided to cancel a spin-off of its cloud division, and that is due to a way slower growth of this part of the business than anticipated. The fact that this company is losing its market share and it is slowing its growth made its founder Jack Ma to reappear from the shadows and publicly urge the company to change and reform. And all of those problems are of course reflected in the stock price, which is 76% down from its peak. So let's analyze and value Alibaba to see, is it really that bad, or is the market irrational and by pushing the price down so much, it created an excellent investment opportunity? Let's start with the recent results. Revenue is up by 8.5% year over year, net income is up by 18.8%, cash went up by 26.2% in the last 6 months, and in the same time, debt went up by 5.9%. So that is not as bad as we could assume by reading the news. But of course, these results are only short term. Let's look at the big picture to really understand where is this company heading. If you were to invest $1,000 into Alibaba at its IPO in 2014, you could buy around 10.6 shares, and today they would be worth something close to $785. So in 10 years, you would lose 21.5%. Not the best possible outcome, but the future does not have to resemble the past. So let's analyze Alibaba to really understand where we are. Individual insiders, that is an X 1.3% of the company is owned by individual insiders. And we would like to see this number over 2% because then we know that the management has its skin in the game. But 1.3% is not that bad. And are individual insiders buying? That is an X. We don't see any transactions from insiders in the last year. And the super investors own this company. That is a check. We see 12 super investors that put their money into this company. And just to name a few, we see Charlie Munger, that unfortunately passed away recently. We see Michael Berry, Guy Spear, or Francis Chu, whose portfolio I recently analyzed, and you can find a link to this video in the description below. And are super investors buying right now? That is an X. In the last quarter, they bought over 2.3 million shares and sold almost 4.8 million shares, so over twice as much. Return on invested capital, that is a check at 12.1% 10-year median returns. And we want to see this number over 10%, so that is a decent result. And free cash flow growth, that is a check at 27.4% 10-year compound annual growth rate. And also here, we want to see this number over 10%, so such growth is very impressive. And what do we know about net profit margin? It is a check at 14.5%, and the industry average is just 4.5%. So they still have a very strong position in the market, and they can use this pricing power to fight with competitors in the future. And now let's take a look at share buyback. It is an X with 8.9% new shares issued since the IPO. But it is important to notice that since 2021, they are buying back shares. So it seems that this trajectory is changing, especially now when the price is down so much. And let's take a look at the debt. It is a check. It would take less than a year to pay the long-term debt with a current free cash flow. So this is very nice. Alibaba does not have to worry about its debt at all. The dividend yield is 1.3%, so shareholders will get $1 per every share annually through dividends. And the payout ratio? That is a check at 21%, and we want to see it somewhere between 20 and 50%, so it is very healthy. We are getting a decent amount of earnings, but at the same time, it is low enough to allow the company to finance its growth. And what do we know about dividend growth? It is an X. The management just recently announced its first annual cash dividend of $1 per share. So it is an annual dividend and it is the first one in the history of the company. So we really don't know if we can expect other dividends in the future, or is it just a one-time thing? Since you watched this video all the way until this point, I have a little surprise for you. Christmas is coming, New Year will begin shortly, so I decided to prepare something special. Charlie Munger used to say that Benjamin Franklin is one of his favorite people in history. So, if you are a patron of this channel, from today you can download for free an ebook written by Benjamin Franklin called The Way to Wealth. It's a short, amusing and very intelligent story about building wealth. If you are not a patron, you can still buy this ebook or just become a patron, get access to our interactive stock ranking and some other extras, and download The Way to Wealth for free. The link is in the description. Now, let's get back to the valuation. Price to earnings ratio is 10.5, so that is a lot lower than the S&P 500 average. At the first glance, Alibaba may look cheap, but to properly value it, we will use a discounted cash flow formula and we will make 3 scenarios of its future growth. So in the lowest scenario, we will estimate a growth of 4% for the first 5 years and then 3%, in the medium 8% and then 6%, and in the high scenario 15% for the first 5 years and then 10% growth. Now, why did I use such estimates? Well, if we look at the 10-year annual growth rate, we see that the revenue went up by 36.6%, free cash flow by 27.4%, and earnings per share by 21.4%. So why did I use much lower numbers? Well, Chinese economy is predicted to grow 4.1% a year between 2024 and 2030 and 3.7% between 31 and 36. So the low scenario predicts that Alibaba will just grow with the Chinese economy. Medium scenario predicts that Alibaba will double that growth, and high scenario is a bit closer to past results of this company. So I think we are conservative, and we should be, because this is a Chinese company and the political situation is very hard to predict, and it may influence this company in a big way. So we should take that into consideration as well. So, with such estimates, the intrinsic value in the low scenario is $140, in the medium scenario $180, and in the high scenario $269. But these are not the prices we should be looking for, because we have to always add a margin of safety. I use a 30% one, and that gives me some extra room for mistakes. If I stick with that, I have a bigger chance of avoiding some serious trouble. So with such a margin, we get in the low scenario $98, in the medium $126, and in the high one $188. And the current price is around $75. So it is all in the green. Alibaba, even with the low growth estimates, seems rather cheap. So we have a company that is doing really well, but not as well as people expected. It's growing its free cash flow nicely, it has big margins, no debt, and it is cheap. But it is a Chinese company, which creates a number of risks. It is trying to reorganize by splitting into a number of smaller companies, but that process is not going very smoothly. Its cloud business was expected to drive the growth, but instead, it is rather stagnant. And we have to decide which story do we believe in. One of them is saying, do not touch this, it is way too risky and unpredictable. And the other one is saying that the price is way too low for such a huge business. And even if it is not doing exceptionally well right now, it still is worth a lot more. So thanks for watching. Don't forget to check out Benjamin Franklin's The Way to Wealth on our Patreon page, and see you in the next one.